We are on to this FM specimen examination, and the FM specimen examination, I'm just going to start off with a section A, and I would actually see and I would actually discuss with you people that what exactly is there in the section A. We would try to do the maximum questions. Now, the first question that is there in front of us is basically about this foreign currency, the forward exchange rate. It says the home currency of ACCA is the dollar, and it trades with a company in foreign country whose home currency is the dinar. So ACCA company has a foreign currency which is termed as dinar. Okay, ACCA has a foreign subsidiary and trades with a foreign country whose home currency is the dinar. The following information is available for the home country and for the foreign country. The spot rate is 20 dinars per dollar. The exchange rate is 20 dinar per dollar. Now, for the interest rates are given for the home country, the interest rates are given for the foreign country. It says what is the 6-month forward rate. Now let me just guide you through that how exactly are we going to talk about this specific thing, because as I told you that what I would do is that I would try to make sure that I do maximum questions from the maximum areas. So first of all, before I go on to discuss this forward exchange rate, so just remember that if you have to calculate just remember that if you have to calculate the forward exchange rate, for the forward exchange rate, what happens is that we use either purchasing power parity theory, or we either use the interest rate parity theory. Now, what exactly happens with this purchasing power parity or the interest rate parity? So let's have a discussion about it. Basically, what you do is that you say under this purchasing power parity, the spot rate multiply by 1 plus inflation in the local currency divided by 1 plus inflation in the foreign currency. So if you have got, let's say, the exchange rate written as dinar upon dollar. So therefore, what would happen is that in the numerator, you would have the inflation of the country whose currency is dinar. And in the denominator, you would have the currency you would have the dollar inflation. So one of them is basically called the purchasing power parity. That's one of the ways of establishing the forward exchange rate. The second way of establishing the forward exchange rate is to use the interest rate parity. How do we establish the forward rate using the interest rate parity? It's actually spot rate multiply 1 plus interest rate local divided by 1 plus interest rate foreign. So that is how you do it. Now in this specific scenario, I repeat, in this specific scenario that is there in front of us, what information is being given to us? Let's just try to see. The question says, in this specific example, the question says that the country in which you are based in, your home country, your currency is dollar, and it trades with a company in the foreign country whose home currency is so and so, so and so. So now what is actually going to happen is that if you have to calculate the forward rates, the forward rates, um, now the forward exchange rate, as I said, could be calculated using both of them. Now, but what happens is that the interest rate parity is going to be used when you have the money market hedge. But when you have got a forward exchange rate, for the forward exchange rate, you would use the purchasing power parity. I repeat, for the forward exchange rate, you would be using the purchasing power parity. Now let's just try to see things. Let's just try to look at the things. We need to calculate the forward exchange rate. We have the spot rate as 20. We have the 3% per year interest rate. We have the 7% per year interest rate. The exchange rate is dinar per dollar, and we need to have the exchange rate for the 6 months. So what are we going to do? We're going to simply say that basically 20 dinar per dollar multiplied by 1 plus interest rate, 1 plus interest rate, the inflation in the country where there is dinar. So it's actually the foreign country. So 5% is the rate. But this has to be power 1 upon 2 divided by, in your home country, 2% is the rate. So 1 plus 2%, and then again it has to be power 1 upon 2. So as a result of this, what is actually going to happen? Try to understand. What you're going to do is that this is one of the ways of doing it. The other ways of doing it is that you could simply say it this way. You could say 5% multiplied by 6 upon 12. You could say 2% multiplied by 6 upon 12. So this is going to be 2.5% and this is going to be 1%. So hence resultingly what happens is that 20 multiplied by 1.025 divided by 1.01. So hence resultingly what happens is that 20.29 is what the exchange rate is going to be for the 6 months. I bet the exchange rate for the 6 months is going to be 20.29. So the answer is going to be 20.29. So we don't have 20.29, so we're going to round it off. Sorry, in fact, just wait a bit. The answer is 20.59, not 29, it's 20.59. So we're going to say 20.59 is the answer. Is that okay to all? Basit, how have you calculated? In fact, what I could see is that 20.29, not 20.59. What I could see is that 20.29. Yeah, it's 20.29. So basically the closest to 20.29 is 20.3. So we're going to just select it. Let's move a bit forward and let's discuss further. The next question is about the following financial information relates to an investment project. And this question, I am using FM specimen paper, Muhammad Khan. I'm using the FM specimen paper. I'm using the FM specimen paper. Now it says that the following financial information relates to an investment project. The present value of sales revenue, the present value of variable costs are given, the present value of contribution is given, the present value of fixed costs, the present value of operating costs, etc., etc., etc. This is all that is actually given to you. Now, what is it that we have to do? We have to calculate. We have to calculate the sensitivity of this specific NPV to the change in the sales volume. We have to calculate. My friend, this is FM specimen available on ACCA practice platform. This is no specific year. Now, when it says NPV to change in sales volume, so how do we calculate the sensitivity? So always remember that whenever you have got the question on sensitivity analysis, what is it that you have to do? You have to make sure that what you do is that you say NPV divided by present value of the item under consideration. Whatever item is there under consideration, you would say that. So now in this case, what is actually going to happen? I bet in this case, it is actually going to happen like this. You've got the NPV to be 1300. The present value of sales revenue is 50025. Multiply by 100. So resultingly, you will end up getting 2598%. So hence approximately 2.6%. I bet approximately it's actually going to be 2.6%. So resultingly, the answer to this is going to be 2.6%. Next requirement to the question is that it says that match level of capital market efficiency that best reflect each of Gurdip and Oliver's belief. Now, there are different types of market efficiencies. One of them is weak form efficiency. One of them is a strong form efficiency. And the third one of them is, basically the third one of them is basically what? The third one of them is this semi-strong form. Now, it says Gurdip company plots the historic movements of share prices and uses this analysis to make her investment decision. Oliver believes share price will reflect all relevant information at all the times. So what happens is that when we talk about the strong form efficient, the strong form efficient market actually means that share price always reflects all the types of information that's available. So for the Oliver company, it's a strong form efficient. Semi-strong is share price. Gurday plots the historic movements of share price and uses this to make her investment decisions. So if the historic historic information is reflected in the share price, it means it's a weak form efficient. Because when it's a semi-strong, it has current and historic both. But when only historic, that means it's actually weak form efficient. No, it's a strong form efficiency, right? Um, the next is about the capital structure theory. So what's the input of you people on this capital structure theory? No, last one is incorrect. Last one is incorrect. Business risk is assumed to be constant as the capital structure changes. No, that's practically not possible, Punit Mishra, that the market is not efficient at all. That's practically not possible. The business risk changes as the capital structure changes. It cannot be the case that the business risk would remain the same with the changing capital structure. So this is wrong. Now, our traditional view, there is a relationship between cost of equity and the financial risk. No. MM said that in the absence of tax, the cost of equity would remain constant. So does the MM says that in the absence of tax? Yes. Right? Uh, right or no? In the absence of tax, remember, in the absence of tax. So in the absence of tax, the interest rate, the cost of debt, or the cost of capital would remain the same. Now, what next is there? What's the fourth one? It says which of the following actions is least likely to increase shareholder wealth? Shareholder wealth means technically the company's share price. Shareholder wealth means technically company's share price, or you could also say that the cash flows for the business. It says weighted average cost of capital is decreased by recent financing decision. So if the WACC is decreased, the value increases. If the WACC is decreased, value increases. So this is going to have an increase in the impact of share. Financial rewards of our directors are linked to increasing earning per share. So obviously the directors would try to earn more rewards. Board of directors decide to invest in a project with positive NPV. The annual report. Now this is one of those things that is likely to have the lowest impact on the wealth. You see, every other thing is going to have an impact on the wealth. Every other thing is going to have an impact on the wealth except for this one, the fourth one. Just for the sake that the company is complying with the code of corporate governance does not mean that its value is going to increase manifold. No, it's not going to happen. Albeit just because the company is complying does not mean that its value is going to increase. No, its value won't be increased. Okay, Basit, we can mark this to be flag, and we could get back to it once we are done with it, right? So, but for the time being, no, it doesn't make sense. Now, next one of them is, which two of the following statements are features of money market instruments? What are money market instruments? The money market instruments are those instruments which have got a maturity of less than 12 months. They are maturity of less than 12 months. So now what does it say? It says a negotiable instrument can be sold before maturity. The discount instruments trade at less than face value. The commercial paper is so and so, so and so. Now, which two of the following statements are feature of money market? Now, what are the characteristics of money market instruments? So with respect to the money market instruments, what happens is that it says a negotiable instrument can be sold before maturity. The yield on commercial paper. Commercial paper is what? Commercial paper is the bonds issued by the government, by the organizations. So it says yield on commercial paper is usually lower than that on treasury bills. No, treasury bills are lower risk. Treasury bills means the bills issued by the government. They are lower risk. So when the treasury bills are lower risk, the lower risk would provide lower return. And the company bonds are usually higher risk, so they would provide higher return. So this two is incorrect. Discount instruments trade at less than face value. Yes, usually. And this one is correct. So negotiable instrument can be sold before maturity. Like you don't have to keep it for 12 months. You could just sell it within short term. Okay. Do you remember the formula of operational gearing? Do you people remember? Yeah. Do you people remember the formula of operational gearing? Okay. Now you see what happens is that there could be multiple formula for operational gearing, but let me just discuss a bit. Basically, the concept of operational gearing is that operational gearing actually tells you the business risk. I repeat, the operational gearing actually tells you the business risk. So there are different ways of calculating it. One of them is basically fixed cost divided by variable cost. One of them is fixed cost divided by variable cost. Now let's just try to see that what is the information available here. Sales income is available as 60,000. Cost of sale is 50,000. PBIT is 10,000. The interest is 4,000. The profit before tax is 6,000. The tax is so and so, so and so. The profit after tax is this, and resultingly, this is what you get. It says 60% of the cost of sales is variable cost. 60% of cost of sales is variable cost. Now, so what do we have to do? We have to say that basically what is the operational gearing of Gohar company? So the operational gearing of the Gohar company is going to be calculated as what? Can you try to calculate? Okay. So the different formulas for calculating the operational gearing could be one of them is fixed cost divided by total cost. That's one way. The other one of them is contribution divided by PBIT. Now let's just try to do this in this specific scenario. Do we have the sales income? Yes, the cost of sales is there. So we could try to calculate the contribution. We could try to calculate the contribution here. Now what is actually going to happen is that you would say the sales, which is 60,000, is given to us. Then what happens is the variable cost of sale. We are being told that the cost of sale, 60% of the cost of sale is what is variable. Hence, what happens is that, do we have any other variable cost? So that's interest which is given. Now, resultingly, what happens is 30,000 is the contribution you have got. The operational gearing is going to be contribution divided by PBIT. So if 30,000 divided by 10,000 gives you 3 times. Gives you 3 times. So 3 times is the correct answer. I bet it gives you 3 times. So 3 times, that's what we have got. 3 times is the correct answer. Yeah, 40% is contribution. Now what else is there? We have got the next question, and it says the management of Lamara company has an annual credit sale of 20 million and account receivable of 4 million. Working capital is financed by an overdraft at 12% interest per year, assuming 365 days in a year. It says calculate the annual finance cost saving if management reduces the collection period to 60 days. So what is actually going to happen is that existing cost is 4 million is your average receivable. 4 million is your average receivable. And this 4 million average receivable is going to be multiplied with 12%. So the average cost right now is 480,000. Now, the existing collection period is 4 upon 20 into 365 days. Now, that is basically 73 days. The existing collection period is 73 days. Now, what is gonna be the receivable balance if we go for 60-day collection period? 60 is equivalent to X upon 20 into 365. So let's say the value of X is gonna be 60 into 20 divided by 365. That's actually gonna be 3.2876. You multiply this by 12%. So hence resultingly, it's 394,521. Hence, the savings that are gonna arise are actually gonna be what? The savings that are gonna arise are 480,000 minus 394,521. So this is actually gonna be 85,479. I bet it is actually gonna be 85,479. So it says to the nearest dollar. To the nearest dollar. So that's what you're gonna do. You're gonna say that what is the existing cost? It's 4 million into 12%. If the receivable collection period is reduced to 60 days, then what is actually gonna happen is that on that basis, it would become 3.8276 million, and you multiply this by 12%, resultingly you end up getting 394. Resultingly you end up getting what? 394521. Now, if this is 394521, what happens is that the savings are 85,479. Okay, it says input does not match. Now, it says identify by clicking on the relevant box whether each of the following statements concerning financial management is true or false. So, what is financial management? It is concerned with investment decisions, financing decisions, and dividend decisions. Is it true? Yes, it's true. It is concerned with financial planning and financial control. It considers the management of risk. It is concerned with providing information about past planned decisions. False. Now you have to decide amongst the two of them. You have to decide amongst the two of them that which one of them is correct. Second one is correct. This one is false, right? Because it's financial planning and financial control. Next situation is that it says Escava has paid the following dividends per share in recent years. So they've got the dividends 2001 till 4. The dividend 4 has just been paid and Escava has a cost of equity of 12%. Using the geometric average historical growth rate and dividend growth model, what is the market price of Escava share on an ex-dividend basis? So how exactly are we going to do the calculation? Let's just try to do. Using the dividend growth model, P naught is equivalent to D naught 1 plus G divided by KE minus G. Now we need to have the growth rate. How is the growth rate going to be calculated? You have got 2001 dividend, you have got 2004 dividend. You would say 0.311 into 1 plus G power 3 is equivalent to 0.360. Why power 3? Because it has grown by 1 year, 2 year and 3 year. So hence resultingly what happens is G is going to be 0.360 divided by 0.311 cube root, and this is minus 1. So what is G going to be? What is going to be the value of growth rate? What is the growth rate? Yeah, can anyone please calculate the growth rate? I don't have the scientific calculator with myself. Yeah, please, anyone, if you could share the growth rate. 4.99%, approximately 5%, right? So we have got the growth rate to be 5%. Now, what are you gonna do? You're gonna say that how do we calculate the share price? It's D naught 0.36 multiply 1.05 divided by 12% minus 5%. So what's the share price, please? Yeah, what's the share price, please? 5.4. Okay, so you get the share price to be 5.4. So the share price is gonna be 5.4. Next is basically this question, and it says this is about the currency risk. There's a risk that the value of our foreign currency denominated assets and liabilities will change when we prepare our account. So that's a translation risk. Because what happens is that at each year end, what you do is that you translate the shares. I bet you translate your assets, you translate your liabilities using the closing exchange rate. You translate your assets, you translate your liabilities using the closing exchange rate. Right? Now, let's move a bit forward and let's discuss further. Now, what next is there? It says the following information has been calculated for Asani company. Required is calculate the length of the working capital cycle. So if you have to calculate the length of the working capital cycle, I could just give you a bit of an idea that how the working capital cycle is determined. It's receivable period plus inventory period, and then what you do is that you minus the payable period. So it's 52 days the receivable collection period plus 42 days the raw material inventory turnover plus 30 days the WIP turnover plus 45 days the finished good turnover period minus 66 days. So hence resultingly what happens is that we just got to see that how much does it turn out to be. 52 plus 42 plus 30 plus 45 minus 66 gives us 103 days. Gives us 103 days. So how much does it give you? It gives you 103 days. Now, it says which of the following are usually seen as benefits of financial intermediation. Financial intermediation means having somebody to broker your deals, all the financial deals, somebody to broker them. So what actually happens is that when you have somebody as an intermediary who acts in between. So what actually happens is that interest rate fixing, you have an intermediary like a bank or somebody who's negotiating or who's acting as a guarantor or something. So maturity transformation and risk pooling are the main things that happen. Now, instead of interest rate fixing, you have got these two things that happen. Risk pooling, the risk is aggregated, plus the maturity transformation is there. Like they could actually take 10 months loan, 11 months loan, 5 months loan, and they could give it out to you, suiting your maturity of 2 years, 3 years, whatsoever. Which two of the following concerning working capital management are correct? interest fixing is, yes, it could be an advantage, but generally it could be done even without an intermediary. Now it says which two of the following statements concerning working capital management are correct. It says the twin objective of working capital management are profitability and liquidity. That is true. The working capital management ensures that both profitability and liquidity is maintained. A conservative approach will increase profitability. Working capital is a key factor in long-term success. Current ratio is measure of profitability. Now, 1 and 3 are correct. Because you see, 1 and 3 are correct. It's not necessary that the conservative policy would increase the profits. It's not necessary. It would rather decrease the profits. Why? Because you are taking long-term loans, and the long-term loans are expensive. The conservative policy focuses on long-term loans, and the long-term loans are expensive. As compared to the short-term loans, long-term loans are expensive. Next question that we have is, it says governments have number of economic targets as part of their monetary policy. Which two of the following targets relate predominantly to monetary? Monetary policy actually means the policy undertaken by the government for the money supply in the economy. So increasing tax revenue, no. The money supply is there, yes. Now, the second is reducing public expenditure, keeping it now public expenditure, or keeping interest rates low. Now, it's not necessary that keeping interest rate low is an impact. The money supply is the major thing. So the interest rates could actually be high also. I don't know, I have a doubt on this, so I'll just flag it. Okay, so we are done with this specific one section, which was section A of the FM specimen examination. Now let's move a bit forward and let's talk a bit further. Next, it says that this is one of the questions that we have. It says power company currently has following long-term capital structure. The loan notes are secured on so and so. Arrange the following sources of finance of power company in the order of risk to the investor with the riskiest first. With the riskiest first. Okay, we need to see. It says 8% loan notes are convertible into ordinary shares per loan note in 7 years time. If not converted, loan notes can be redeemed on the same future date. Power company has cost of debt of so and so. Ordinary shares have a nominal value of this. Current ex-dividend share price of the company is this. Loan notes are secured on non-current assets of power company. Loan notes and bank loan is secured by floating charge on the current assets of the company. So most risky is the ordinary shares. Second risky is redeemable preference shares. Third risky in this case is going to be bank loan. So when you've got a floating charge, that's more risky. The fixed charge is lowest risk. This is most risky. This is less risky. This is lesser than this, and this is lowest risk. Then it says calculate the conversion value of the 8% loan notes of par after 7 years to 2 decimal places. So how would you calculate the conversion value? It says the 8% loan notes are convertible into 8 ordinary shares per loan note in 7 years time. If not converted, the loan note can be redeemed on the same future date, so and so, so and so. Ordinary share price, ordinary shares have a value of this. Current ex-dividend share price of the company is 10.9. Now, how exactly are you going to calculate the conversion value? So for you to be able to calculate the conversion value, let me just guide you about it. Conversion value is going to be the number of shares multiplied by the expected share price. I bet the conversion value is going to be number of shares multiplied by the expected share price. So what happens is that for every single loan note is convertible into 8 ordinary shares. So 8 shares multiplied by. The price right now is 10.9. And this price is expected to grow by 6%. Power, how many times? In 7 years time. So this is right now. So that means it's gonna grow by 7 times, right? Hence, resultingly, how much does it turn out to be? Yeah, how much does it turn out to be, please? $131.11. And they want the answer to 2 decimal places, so you're gonna give it like this. Next is it says assuming conversion value after 7 years is 126.15. What is the current market value of the loan notes of par company? So basically what happens is that what do you need to do? You need to say year basically what do you need to do? You need to calculate the present value of cash flows. Now what actually happens is that year 1 till year 7 interest is there, and that interest is basically that interest is 8% multiplied by 100 gives you 8. You multiply this with 7-year annuity factor at the rate of 9%. That's one thing that you have to do. And then year 7, this cash flow of 126.15, you multiply it with 7-year PV factor at 9%. So can you just try to calculate them? You don't just have to discount the conversion value, but rather you have to discount all the cash flows. So it gives you 109.27. The total value is basically 109.27. No, 634.9. How could it be, my friend? This is the correct answer. You see, 8% into 100 means 8. 8 multiplied by 7 year, annuity factor at 9%. Then you've got 126.15 multiplied by 7 year PV factor at the rate of 9%. It says which of the following statement relating to CAPM is correct. The equity beta of power company considers only business risk. No. Equity beta considers both the business and the financial risk. CAPM considers systematic and unsystematic risk. Yes. The equity beta of 1.2. Because whenever you've got an equity beta of more than 1, this is an indication that the company is risky. So this is the final part of this question. Which two of the following are problems in using P ratio method to value a company? So when you use P ratio, the price earning ratio. So price earning ratio is share price divided by EPS. Now what problem? It says it's the reciprocal of earnings yield. So it's not a problem. It combines the stock information and corporate information. Okay. It is difficult to select a suitable P ratio. Yes, that's the issue. What's gonna be the suitable P ratio? Because you just cannot pick up the industry P ratio. You have to adjust it. You have to talk accordingly. And lastly, the ratio needs adjusting when valuing the shares of unlisted company. So we are done with this part of the question. Okay, let's have a discussion. Sorry, my internet got some issues. So anyways, now let's go back. It says Zerona company whose home currency is the dollar took out a fixed interest peso bank loan several years ago when peso interest rates were relatively cheap compared to the dollar interest rates. Now what happens next is that Zarona company does not have any income in pesos. Economic difficulties have now increased peso interest rates while dollar rates have remained relatively stable. You must pay interest on the date set by bank. A payment of 5 million pesos is due in 6 months time. The following information is available. Spot rates are given, 6 months forward rates are given. Interest rates which can be used by Zarona are as follows. It says calculate the dollar cost of a forward market hedge to the nearest dollar. Now what happens is that there are few important things with respect to, there are few important things with respect to this hedging. Now first of all, the important aspect of this hedging is that if you have to use the forward exchange rate, so you need to understand the first thing, if it is a direct quote or if it's an indirect quote. So when you actually see this company itself, Zarona, is a home currency of dollar. So this means it's basically the exchange rate is foreign currency divided by local currency. So it's an indirect quote. Now the second thing that you have to understand is that what is it that you wish to do as an entity? What is it that you wish to do as an entity? So as an entity, what you wish to do is that you have to must pay interest on the date set by the bank. A payment of 5 million pesos is due in 6 months time. So that means you have a payment of 5 million peso. So Zarona should buy peso. Under the indirect quote, the entity buys foreign exchange at lower rate. Hence, applicable rate is going to be 12.805. Resultingly, if the applicable rate is going to be 12.805, resultingly, what's actually going to happen? Try to understand. What's actually going to happen is that the amount in dollars is going to be 5 million divided by 12.805 is equivalent to how much? So that's actually going to be 390472. 390472. I bet 390472. So your dollar cost to the nearest dollar is going to be next. It says indicate by clicking on the relevant box whether each of the following statement relate to interest rate parity only, to purchasing power parity only, or to both. Okay, now what's are the statements? The currency of the country with the higher inflation rate will weaken against the other currency. So when it comes to inflation, inflation actually means purchasing power only. The theory holds in the long term rather than in the short term. This is a hot word. The exchange rate reflects the different costs of living in two countries. That's basically both the interest rate parity and the purchasing power parity. Next it says what are the appropriate 6-month interest rates for Zarona to use if it hedges the peso payment using money market hedge. Now try to understand what happens under the money market hedge. Under the money market hedge, we We borrow we borrow in one currency and deposit in another currency. Since foreign exchange payment is to be done, hence foreign exchange deposit is to be created and local currency loan to be obtained. So what happens is that foreign exchange rate is 7.5% multiplied by 6 upon 12 is equivalent to 3.75%. Local currency loan rate is gonna be 4.5%. Multiply 6 divided by 12 gives you 2.25%. Do you understand this? Which two of the following are possible ways for Zarona to hedge its foreign currency risk? Currency swaps, currency futures. Last part of Zarona, it says Zarona also trades with companies in Europe which use the euro as their home currency. In 3 months' time, Zarona will receive euro 300,000 from a customer. Which of the following is the correct procedure for hedging this receipt? Now, if you are going to be receiving the foreign exchange, if foreign exchange is to be received, so foreign currency loan to be taken, local currency to be deposited, on receipt date FX loan repaid. So on the receipt date FX loan is repaid, and what else is there? Local currency withdrawn. Let's try to see that which of them is matching it. Borrow amount in euros, okay. Convert euro to dollars, yes. Place the dollars on deposit, yes. One is correct. Kindly look at it. We're done with this question also. That was about Zarona. Okay, now it says in relation to RIDAC, which two of the following statements about competition and deregulations are true? So it says RIDAC operates in an industry which has recently been deregulated as the government seeks to increase competition in the industry. As the government seeks to increase competition in the industry. RIDAC plans to replace an existing machine and must choose between two machines. Machine 1 has an initial cost of this and will have a scrap value of this. Machine 2 has an initial cost of this, will have a scrap value of this. Where relevant, all information relating to this project has already been adjusted to include inflation. Now it says, in relation to RIDAC, which of the following are true? Increased competition would encourage RIDAC to reduce the cost. Yes, the competition forces you to reduce the cost. Deregulation will lead to an increase in admin cost. No, it will reduce because when regulated sector compliance cost is high. Deregulation should mean an increase in economies of scale. Deregulation means increase in economy. That's your own decision, but that's usually in the case of regulated sector. Deregulation could lead to a decrease in the quality of the IDEX product. Yes, supervision would not be there. Supervision would not be there. Now it says, what is the equivalent annual cost of machine 1? How do you calculate the equivalent annual cost? Let me just tell you that if you want to calculate the equivalent annual cost, machine 1 has an initial cost of 200,000, time period 0, negative 200,000. And have a scrap value of 25,000 after 4 years. Machine 2 has an initial cost of so and so. 1 till 4, sorry, 1, 25,000. 2, 29,000. 3 is 32,000. And 4, there is basically 35,000. At the same time, at 4, there is an inflow of 25,000. Now, what you do is that you use this 7% after tax cost of capital into 1.07 power minus 0. So you have got this 25,000 into so and so, so and so, so and so. Now, whatever the present value comes in, you divide it by 4-year annuity factor at 7%. So can you just let me know what's the equivalent annual cost? Yeah, can you just let me know what's the equivalent annual cost? Okay. Okay, so what's the correct answer? What's the correct answer? Okay, A is the correct answer, right? That's what you have got. It says that you have to use this formula. You have to use this formula, right? Just make sure that you use this formula. Yellow. Okay, now let's move a bit forward and let's discuss further. No, it's not 5. It's not 5. It has to be 4. Did I write 5? Okay, my mistake. Sorry. It has to be 4. Sorry, it has to be 4. Okay, I don't know. I am not using the calculator. You people are using it. Just try to see whatever the correct answer is. Let's try to do this one. Okay, so it says in each of the following statements about RIDEC, use of the equivalent annual cost method, true or false. RIDEC company cannot use the equivalent annual cost method to compare machine 1 and 2 as they've different useful life. No, that's what the purpose for using it. That's what the purpose of using it. The machine which has the lowest total present value of cost should be selected by RIDEC. No, the machine which has the total lowest equivalent annual cost should be selected. That's what the answer should be. The machine with the lowest equivalent annual cost should be selected. It says doubt has been cast over the accuracy of year 2 and 3 maintenance cost for machine 2. On further investigation, it was found that the present value of potential cash flows are now predicted. Year 2 is this, year 3 is this. Calculate the expected present value of maintenance cost for the year 3 to the nearest dollar. How exactly are you going to do it? Let's try to see. You're going to say for the year 3, it's actually going to be 23,000 into 0.2 plus 24,000 into 0.35 plus 30,000 into 0.45. So hence resultingly what's going to happen? So it's 26,500. Now the last question of the OTQs. RIDEC is appraising a different project with positive NPV. It is concerned about the risk and uncertainty associated with this other project. Which of the following statements about risk and uncertainty on the project is true? So it says sensitivity analysis takes into account the relationship between project variables. Does it? Does it? It does not. Probability can be used to assess uncertainty associated. No. Uncertainty can be said to increase with project life while risk increases. Yes, this is correct. So C is correct. Only C is correct. Only C is correct. Right? Okay, good enough. So what have we done? We have actually gone through all the OTQs and all the MCQs of MCQs of this specific paper, FM specimen paper. If you have any queries till now, do let me know.